Hi everyone, I'm Paisley Nardini, a portfolio manager and asset allocation strategist at Simplify. I'm joined by Charles McGarraugh and super excited today to have a conversation about managed futures and trend following broadly. Before we get into the topic at hand of what's moved markets, what we're looking at going forward and its role in a portfolio, Charlie, I'd love to hear from you why we're excited to talk about this today. And I've heard you mention that it's really a bull market for diversifiers in a portfolio. Can you elaborate on that?
Yeah, well, thanks for having me, Paisley, and it's always great fun to catch up. So I really do have high conviction that it is a bull market for diversifiers, and that the next decade is likely to see a reach for diversification in the same way that the last decade or two saw a reach for yield. And there's some pretty obvious points, and then maybe some less obvious points, kind of illustrating that the importance of alternative return streams now, and the particular importance of them. Firstly, uh, equities are fully valued. America has massively outperformed the rest of the world. Uh, there is, precious little margin of safety in equity valuations. You can have the view that the American markets will continue to dominate global markets, and that would be great. I'm sure that would be fantastic for all of our clients, and we certainly wish the market every success. But price matters. Profit margins are at the highs, concentration of profits are at the highs, and valuations are at the highs. And so there's a lot of things that could go wrong to impede equity returns to make the next decade perhaps less attractive than more recent memory. We got a little taste of that in 22, and I definitely think that more of that is possible. Secondly, on the bond side of the equation, yes, interest rates are higher, but the fiscal deficit is absolutely enormous. We're looking at the possibility of a showdown between the managerial technocracy in the form of the Fed and the executive branch, and possible divergences in monetary policy versus the rest of the U.S., which are made greater with tariffs and deglobalization flows more generally. The punchline is bonds are risky, and they're trading like they're risky, and there's a lot of uncertainty around how that might play out. So a buy and hold of overvalued equities and risky bonds is not necessarily a shoe-in obvious thing that will definitely make money. We all know that past performance doesn't guarantee future returns, but I think at this moment in time, the typically passively allocated two buckets present perhaps a bit more risk than usual.
Yeah, and I would echo that just given some client conversations in just the last quarter, despite equity markets moving higher, we have had a lot of inquiries on how to think forward and think into 2025 with these lofty valuations, some of the bond market volatility. So I do echo your comments and your belief around the need for additional sources of risk and return in the
Yeah.
portfolio.
And then to build on that, that's kind of, to me, the straightforward bit. And then there's the perhaps somewhat less straightforward part, which is that bonds and equities have become a lot more correlated in the last couple of years.
Yep.
And if the core problem that every wealth allocator in the world is basically trying to solve is I own equities, so I've got some leverage to economic growth. What do I own alongside it to sterilize some of my risk and balance the portfolio? The answer for the better part of 30 years has been bonds. And I'm just not sure that that's really the right answer right now if it's the same return stream to a first approximation because they're so correlated. So the volatility drag could impede on portfolio returns, and the risk is perhaps compounding up. So I'm not sure bonds are quite the performant hedge they once were, even though interest rates are higher. And so stuff that's truly uncorrelated may be more attractive.
Yeah, I concur with that. I think you making that comment maybe 2 or 3 years ago, I think people would have been like, ah, what's Charlie talking about? But 2022 was a prime example that brought that to life. And so I do think that's been what's maybe driving some of this innovation and launching of new strategies really within the liquid alternative space. And just alternative private market assets broadly is really thinking about what 2022 did for the market at large, and thinking about, the 60/40 or that balanced portfolio, how do you build a more well-rounded approach, I would say, going forward? So all of these topics we'll discuss, especially that stock bond correlation, because I think that's really an easy visual or proof point as to, why we're excited to talk about this asset class here today.
Sure. For sure.
So with that, maybe we'll provide some introductions for our listeners. I had briefly mentioned I am a portfolio manager and asset allocation strategist at Simplify Asset Management. We launched in 2020, really to take advantage of an SEC rule change that allows the use of derivatives and ETF portfolios, allowing us to bring more innovative strategies and really focusing on enhancing yield, looking at ways to diversify, traditional stock bond portfolio risk. And my role here at Simplify is to oversee our asset allocation strategies, our model portfolios, and our alternative suite of strategies. So, Charlie, if you wouldn't mind providing a little bit of background on yourself, you've had a really interesting career path that I think makes you really well suited for being in this trend following managed future space.
Sure. So I'm Charlie McGarraugh. I am the Chief Investment Officer of Altus Partners. We are a European-based asset manager focused on managed futures. So we have both hedge fund and related strategies, and also advise Simplify with our intellectual property on how to run some of Simplify's ETFs.
And maybe the one thing I can mention too, for just a fun fact, Charlie and I just met a few months ago and realized that we're both from Minnesota. So we definitely hit it off. We've had a lot of conversations since then, and we're both spending a lot of time talking to clients, building a case for this asset class. And so super excited today. Charlie, would you mind sharing a little bit of background as well? Just being in more the trend following of from a commodities lens and kind of your experience at Goldman.
Yeah, sure. So I joined Goldman right out of undergrad, where I was a trader for 16 years, starting in emerging markets and then credit derivatives and corporate credit. I moved on to mortgages and was a mortgage trader throughout the height of the subprime crisis. And I moved to London to work on European asset-based lending and asset-based finance and trading, mortgage trading in the early 2010s. I was promoted to partner in 2012, largely on the back of the success of that post-crisis European banking system business. And I became global head of metals trading in Goldman's commodities group in 2014. I left Goldman in 2016 because I wanted to work more on machine learning and electronic trading. And I've had a nice wild ride as an entrepreneur since then. I had an automated sports betting business. And I was also, which I sold to blockchain.com in a pivot to crypto in 2018. And I was chief strategy officer at blockchain.com for a time. And since 22, I've been running Altus basically full time.
I think that's awesome. I mean, such a diverse career path that you've had. I've been just thinking like we could have like 4 different episodes today on the various stops that you've had along the way. But in the interest of time, and our audience is listening for the purpose of managed futures insights, let's start with the basics, right? Let's level set, make sure everybody's on the same page. And from your perspective, Charlie, the very simple question, what are managed futures? And really, what's the main reason that these are in portfolios?
Yeah, so managed futures are fund or trading strategy products where the mandate is to buy and sell futures contracts. And the futures markets are really interesting and really amazing because they are a very liquid place where a lot of risk moves around the system. They are also intrinsically leveraged because you're basically betting on how much a price will move in a side pocket to the actual thing. And they're some of the oldest and most established markets in the world because they originally came into existence for agricultural hedging. And the reason they're called futures is because you would grow your crop and then have to lock in the price when the end of the growing season was done, basically. So in the future. So futures markets are very liquid places where the industrial supply chain trades commodities. and where lots of institutional investors trade financial assets in the form of futures contracts. So things like futures on equity indices and futures on bonds and so forth. So they're very liquid, very well established, and their leverage is incredibly efficiently priced.
Yeah, so I would
So
say,
that's the market. Sorry, Paisley, I interrupted you. Go ahead.
no, I was just going to say to your point then, futures can be utilized for both hedging purposes. You mentioned some commodity or like say oil prices, but then also for speculative reasons as well, which kind of further boosts market liquidity and makes it a very natural strategy to be in a daily liquid wrapper, like an ETF for mutual fund.
Yeah, for sure. And I think the main upshot is the futures markets are where risk goes to get moved around efficiently by people who need to move it and manage it. And that means that you can get a lot of with a lot of transparency, you can move a lot of size around the system. So if you're in the job of taking and managing risk, which amounts to making predictions about the future and then reacting effectively to new information as it comes in, the futures markets are a great place to do it because there's a lot of different things happening in a lot of different places. There are many regulated futures exchanges around the world. So it really is a global market. And then managed future strategies in particular are funds or other managed investment strategies where a professional manager has a mandate to take risk in the futures markets with client capital in order to create returns. So it is a managed product, and it is, at least in the US, it comes under a slightly different regulatory framework typically in the form of CTAs and as advisors, and then commodity pool operators as actual managers of pooled capital.
Yep.
So
Okay, that's
that's
super
managed futures.
helpful. Yeah, and I would say too, the role of managed futures in a portfolio is really in that diversifier or alternative sleeve in a portfolio. We talked very briefly, which we'll dive into here in a moment, really about the correlation between stocks and bonds and why investors would look to diversify their risks in a portfolio. So managed futures are really that can be that ballast, or oftentimes they're referred to as crisis alpha, meaning that they perform when markets roll over or hit, these bouts of volatility. And we've seen that play out. We'll talk about some of the historical performance as well. So I think that's enough probably for some background. But again, if any questions or want to engage in a deeper dialogue, Simplify is really focused on providing education. So always happy to have that conversation. So let's dive right in. We'll set the stage before we get into kind of some current maybe themes or opportunities in the space, but would love to start with maybe what I consider sometimes the elephant in the room is when managed futures maybe have not performed. And I think a lot of us, and especially I'm hearing this in client conversations still, even today, after we've seen strong performance from the asset class in 2020 and 2022, but I think a lot of investors are still tethered to this post GFC era. There was a really kind of meaningful rush into the asset class post 2009, 2010, because investors saw the benefits of these in a portfolio. And then we had this kind of what I would call like the lost decade for managed futures after that. So, Charlie, would love to hear your thoughts on why managed futures as an asset class struggled a bit in kind of the early 2010s. And then we'll kind of go from there.
Sounds good. Yeah. So I think that when you're considering that question, it's important to frame it through the lens of what is it that managed futures are really supposed to do. And fundamentally, most systematic futures managers have an element of trend following in them. And the reason for that is that momentum or breakout or trend, however you want to call that idea that a change happens and then through time more of the same happens, right? That idea is a pretty historically anyway provable statistical source of predictive edge, and it's an important component of what most of the space is focused on. So trend
And
following is a piece of the
maybe just
space.
a pause there. I'm just thinking about, again, maybe a wide range of backgrounds listening in on this. And I come from the factor world, really, in equity investing. And I'm just wondering,
Yeah.
is trend following in what you're describing similar to, say, like from an equity style perspective, like the momentum factor? And I think that might be
For
something
sure.
most of our audience is probably
It
more
is.
familiar with.
Yeah, it is. It totally is. And I think the way I think of it is a trend is the process by which a market ingests fundamental information and reflects it in the price. So a trend is neither long volatility nor short volatility, because volatility can happen as a response to real change in the world or noise, right? But if you're moving and then moving more in the same direction, it's because something for real is changing, probably. And so I think of long trend as kind of the same thing as long fundamental change. And the challenge with the post-crisis era now, to answer your question, is when viewed through that lens. Let me rephrase your question. Why didn't trend following work very well after the financial crisis? And I think there's a fundamental reason, which is global governments stood up and backstopped the markets in an attempt to prevent fundamental change from occurring. We can have all of our views about what caused the crisis or what might have happened had the government not stood in. But the functional upshot of interventions, both in the US and in Europe, was that the velocity of institutional change in the system was taken way down through a combination of state backstopping of the banking system, basically,
So
on both
essentially
sides.
stifling of volatility.
It was an intentional policy of volatility suppression. And that may be a good thing for the world. I'm not opining on whether that was good or bad. But the functional upshot of it is that the pace of fundamental change was reduced. People talked about this in the form of the great stagnation, the savings glut, negative real yields. This basic idea that productivity is low, there's excess capital sitting around, and not that much is happening. This is sort of the idea. Now, you might say, oh, well, there was a lot of financial asset inflation. It's like, there was, but it kind of all happened in bonds really fast. Because rates went down and then they kind of didn't do anything for a long time, especially in the front end. And then the second piece of it that relatedly is that the cost of capital was super low for a long time. And so if your job was to provide capital to the market and help it get to its place of, from a pricing perspective, that it wants to go to sooner in exchange for a risk premium return on your capital, well, number one, the amount of change that was happening was low. And number two, capital was super abundant, so it had very little pricing power. And the combination of those two things, I think, added up meant that there was relatively low returns to the trend alpha versus, say, the historic timeline previously. Interestingly, I don't think that it was a function of crowding in momentum signals. And if you look at total assets under management in the managed futures industry, they've been relatively constant, even though financial assets have massively inflated in the past 2 decades. And so I don't think it's a function of, hey, there's too much capital chasing these alphas. I think more like these market conditions were not conducive to the alphas at that time.
Yeah. And I think that's a great point. I think part of what we and other managers in this space are hoping happens in the next several years is to just shine a light on this asset class for investors to see the value of it in a portfolio. So I do hope that that becomes a greater slice of the broader pie. But I do
Yeah,
want to
well,
follow up. Sorry, go
yeah, go
ahead.
ahead. No, I was just going to say, to build on that, think about the way the world is now. The need for this is higher because the bond equity correlation is biasing more positive as a result of inflation volatility, right? And uncertainty around liquidity conditions, basically, number one. Number two, the pace of fundamental change is picking up because governments worldwide have moved from a policy of intentional volatility suppression to a policy of intentional volatility creation.
That
Starting
was
with the
going to be my
pandemic, we
question.
have, oh, okay, well, sorry, front ranking
No,
question.
that's
I really
perfect. I was going to go there. I essentially wanted to ask the obvious question is like, well, what's changed? Because I think there's still this belief, right, that, and I'll just be US centric here for a moment, when we hit these pockets of volatility, the Fed steps in. It's the Fed put, right? So what are your views then? And then you were starting to speak to
Yeah.
them on why the environment today is different and why we won't see the
Yeah.
suppression of volatility going
So,
forward, perhaps.
yeah. So I guess that in my head, there's a couple of really important things that are different now versus the sort of lost decade for managed futures. Number one, the cost of capital is high. So if you're providing risk capacity to the system, you can probably earn a bigger return than you could before just because all risk premia are higher. And that's a function of just capital availability. Right. Secondly, and I truly believe as a side note that trend following is a liquidity provision strategy in some sense, because you're helping the market get to where it wants to be with your balance sheet capital. So that's the first thing. The second thing is the bond equity correlation is positive now, or is biasing positive, and it is my personal opinion, past performance, not future, indicative future results. It's my opinion that the bond equity correlation is likely to skew very positive for a long time because there's so much uncertainty around liquidity conditions. And when liquidity conditions are uncertain, right, if there's more liquidity, all assets go up. And if there's less liquidity, all assets go down. It's a very pro-correlated concept, as opposed to uncertainty around growth, for example, where if growth is high, equities, which are the profit stream, go up, and all the fixed income instruments have to sell off to be more relatively attractive or equally relatively attractive. In a world of high liquidity uncertainty, to me, bond equity correlations is positive. So I think that's another huge change that argues just generally for the value of diversifiers built through active trading. And then thirdly, perhaps most importantly, like I said, I think the government is creating volatility instead of suppressing volatility as a policy imperative. Starting with lockdown, right? Actually, starting with the massive fiscal pro-cyclical fiscal policies of the Trump administration in version 1.0, actually.
Mm-hmm.
But lockdown is being sort of the super obvious example, but also things like starting wars, trade policy, tariffs, however you want to do it. Basically, the hand of the government is in there stirring the pot, and it does not feel any longer like the policymakers' agenda is reduce the pace of change. It's more like wherever you are politically in the world, there's people with big ideas trying to impose their big ideas on the polity. And that has really profound implications for the market because the pace of fundamental change is picking up.
So this is maybe an off-topic question, but just kind of poking at that stock bond correlation and your belief that it will likely remain elevated in the near term. You know, equity markets are down 15-20% this year. Do we not anticipate, the long bond to rally in light of that? Like giving, and I this is more going back to like a portfolio construction conversation because I know long high quality government, treasury bonds are a typical portfolio hedge for equity beta. So just wondering your
Yeah.
thoughts on that. Like what
I think
happens?
it depends. Yeah, I think it really depends on the reason equities are down. If equities are down because there is a recession and growth is surprised meaningfully to the downside, then I think bonds rally a lot and you see a really nice implementation of that anti-correlation. That's entirely possible,
Yep.
although I don't think that's the market's consensus view at all at the moment. But if equities are down because they're overvalued and re-rating, and there's just not as much liquidity around to buy them, because the liquidity is being crowded out by government bond issuance because the fiscal position is so offside, and there's more and more risk premium out in the bond curve because nobody knows how much issuance there's going to be on the forward from the government. Or if we have an uncertain and ongoing pace of implementation of aggressive trade policy that's requiring constant adjustment and higher risk premium in bonds, that could also take down earnings. It could slow down the pace of capital investment, and that will likely hurt bonds and equities at the same time. And I would categorize that entire sort of second group of stuff I described as liquidity uncertainty.
Yep.
Just how much money is there sloshing around the system? If there's more, everything's going up, and if there's less, everything's going down. Fundamentally, it's just some really basic level.
Yeah, so really the catalyst for that stock bond correlation to resume its, typical a recent historical trend of offering that diversification is in light of kind of the traditional recession. And I think to your point, from a consensus perspective, and that can change quickly, um, from a data perspective, we aren't necessarily seeing clear signs of a recession. So it's more of that, like the volatility around geopolitical risks, around tariffs, administration deficit. And so like if you think about it like a T chart and you have like standard recession on one end and then all the other possibilities for
Yeah,
heightened volatility on the other, like the case for stock bond correlations to remain elevated seems to be a stronger case in today's market.
I think so. I think it's really about a basic framework where it's like the fiscal deficit is likely to stay highly stimulative. What's unknown is the Fed's response to it. We're going to have reasonably high nominal growth, and we're going to spend a lot of time asking ourselves, is it real or is it nominal? And that will have everything to do with uncertainty in liquidity conditions and less to do with is the economy nominally in recession or not. So it is certainly possible, of course, that view is wrong. But if I had to guess, I would guess that we're looking at a world of much higher stock bond correlation simply because inflation volatility is so much less certain. And so the market's constantly going to be revising its thought process around how much incremental liquidity is sloshing around the system, especially as viewed through the light of the prism rather of the Fed's reaction function.
Yep. Okay. Well, a lot to keep a finger on heading into 2025. Appreciate some of those macro comments as backdrop. And I think it is really important. You can start to understand like how this asset class is really at the mercy of broader macro volatility, trends in asset pricing, and what that means from the opportunity set. So I want to talk about portfolio allocations, but I think I'll reserve that for after our comments more on the mechanics or the process around managed futures. So one thing I think we do know is from a dispersion perspective, this asset class can be perhaps greater than stocks and bonds, which is typical of really any asset class where there's, strong alpha opportunity. So thinking about trend following and kind of the heterogeneous nature of this space, from your perspective, and of course you might be biased just given your experience and kind of your current model that you operate, is what really drives dispersion in trend following or managed futures? And ultimately, like, what does your toolkit look like? Like, what levers do you have in order to help navigate
Yeah.
that?
Yeah. So when you talk about dispersion, I assume you mean the dispersion of performance between
Correct.
individual managed futures managers in any given segment of time.
Correct.
There is quite a bit of dispersion in this stuff for sure. I would say that it's driven a lot by the details of the implementation. So there is, for any kind of active factor, right, where there's some, let's say, discretion involved in how you architect and manage it, then when my basket of what's high momentum might be different than yours because I'm looking at a different wavelength of change through time than you are. And so some of these implementations are reasonably sensitive to things like wavelength choice. And then they're also quite sensitive to whether you're blending your momentum alpha with some other set of rules to try to make predictions about future returns and volatility of the market. Generally speaking, I would say from a statistical perspective, it's easier to predict volatility than it is to predict returns. But both can change, and neither is a perfect science for sure. But there's quite a bit of implementation details that drive individual manager dispersion through time. Now, a lot of people look at that and say, geez, that's tough. If all I'm really trying to do is pull out a general idea of trend following, how do I even know what the benchmark for trend following is? And of course, there are indices that do that, whether it's the SocGen trend indices or some of the others in the market. But I view it actually as an opportunity because there's an opportunity to differentiate more. You're not just buying the same old equity beta that you buy from anybody. You're buying a manager's ability to think thoughtfully about this and deal with the fact that the optimal wavelength changes through time, and needs to be thought through.
Is it
So
pretty
there's a chance to
common?
add more value than normal.
Yeah, is it pretty common within trend following? I mean, obviously it's systematic in nature, but to have kind of a multi approach. I mean, you briefly mentioned, beyond just the momentum of trend following, there's other ways to capture alpha and think about positioning. Obviously, at Altus Partners, you guys
Yeah,
have a firm belief in the value add of incorporating additional signals. So, can you just share a little bit about, maybe how you think about that and what are the other levers that can
yeah,
be pulled?
for sure. So the short answer to it is there are anything that can create statistically, sorry, that was not articulate. I'm gonna have to edit that one out. But anything that can create statistically additive prediction capability for future returns or risk can potentially add value in a managed future system. Because the basic idea of what you're doing is you're trying to make as many bets as you can, right, with as much edge as you can, sized appropriately. So that's sort of the fundamental equation of hedge fund returns is number of bets times edge per bet times sizing, right? And to get that number of bets up, we want to trade lots of different stuff, ideally as uncorrelated as possible because you want independent bets, right? The sizing has to be thought through efficiently, and the functional upshot of all that is you want to be bigger when you've got more edge and smaller when you have less edge to the best of your ability. And you don't want to have big size if it's just risk without edge because that creates volatility drag. And then on the bit of where it's creating edge, that's tough, right? Because we see the momentum factor, or what in managed futures world we call trend. And historically, it's had some good statistical explanatory power for future returns. And then the question is, can you find anything else? And if you do find anything else that also gives you explanatory power, is it, explanatory power over and above what you already are getting from a trend signal, which means is it anti-correlated? And we are very open-minded about that. And we found quite a few things. And we're working to find more. And if we do, that'll show up in all of our products to benefit our clients, of course. But some of the things that we found are carry, right? The power of doing nothing. Like if you just sit there, maybe the market will hold you to be in the storage, or will pay you to be in the storage business, not just in the moving business, right? And then, of course, there's relative value type stuff, like how does this look versus other stuff? And you can think of things like trend and mean reversion on the basis of how something looks versus other stuff, not just how is it trended versus its previous historical prices. And so, yeah, I would say carry and relative value are the two other lenses we use in addition to trend.
Yeah.
I mean, you should edit that to put that at the beginning of that very long rant instead of the other way around. But, that's the
No,
basic idea.
I think that's helpful. And I just wanted to shine, like I said, a little bit of a light on what really is the rationale behind maybe some of the higher dispersion returns that we see in this asset class. And I do think too, it's also an asset class where managed futures strategies have diversification benefits versus their peers because of that higher
Yeah.
dispersion nature. So that's something as well. We see a lot of clients think about how to
Yeah.
pair maybe two, even three different managed future strategies because they all have different markets that they're trading in. They have different levers, they have different optimization processes and think about positioning size. So
I would just add a couple of points to that thought. The first is if you're going to buy an index of a cross section of managed futures managers in an attempt to reduce the dispersion risk versus the space, all that you're really going to get out of that in the end is a diluted version of the trend alpha. Because basically, everybody's got the momentum factor in there. There's a lot of nuance in how it's built, but you're going to end up with that, and then probably the rest of it will cancel. That would be my opinion, or at least my prior. Maybe I'm wrong, but I think there's that. And then secondly, if you're trading breakout strategies like extension strategies, which I guess is what trend is, markets tend to have these sort of power law distributed outcomes. If you're the winning single name stock, you don't just go up a little bit, you 100x over a decade or 2 decades, right? So you're going to get these extensions. So if you're basically backing winners and then continuing to back winners and shorting losers and continuing to short them, you can get these like desirable skewness properties in the return profile, which can sometimes help.
So one thing you mentioned, just thinking about the potential for alpha, and I think one thing we haven't talked about necessarily yet, which I hear quite a bit of on, other podcasts or discussions around managed futures, is the horizon of the trend. So whether it's short, medium, and long-term trend, how do you think about those windows as another kind of like
Yeah,
lever for thinking about markets? And, very
yeah,
high level question, but as you think about the opportunity set, is there a part of that time horizon for trend following that you think is most advantageous?
yeah. It's a great question. I think there's no free lunch in the market. Everything is a trade-off, right? And with this one, I would say that the longer the trend, in some sense, the more believable it is, but the lower its Sharpe ratio. Because if you're making long-term trend bets, you have to sit around and hold the thing and warehouse a lot of risk and eat a lot of noise in the meantime. So in some sense, I think long-term trend following has tended to be the thing that has worked for people. And that's because short-term trend following, uh, when it works, is like too good. Because you get a high number of bets on, they cycle really fast, you get a big Sharpe ratio out of it, and then and it's not very capital intensive because you don't have to warehouse that much risk. And lo and behold, more capital comes into the market to chase it and it arbs it away. Now, to the extent capital gets more expensive overall for everything, I think the returns to short-term trend can kind of go up, just in line with more pricing power for capital provision and anything. But I think that impact is probably bigger in long-term trend because you're wearing risk, right? Just from a noise warehousing perspective.
Yeah.
Now, we try to use all the above, and we are monitoring their statistical prediction power. We built our systems to try to suss out both short-term trends and medium-term trends and long-term trends. And we try to blend all those things because we think that diversifying signal across multiple approaches is perhaps a way to get more signal in aggregate out. So in the same way that we would blend signal when trying to predict a single asset, in some ways is very analogous to diversifying a portfolio. You're just getting diversified in signal instead of in tradables.
Yep.
Um, but yeah, so I don't think there's a right answer or wrong answer, but the bottom line is the whole point of a strategy like this is you're getting paid to warehouse risk. And a short-term trend is working too well, you're really not taking very much risk, which means, unsurprisingly, it's more heavily competed. And I think that's part of why short-term trend has tended to work less well over time and seems to work less well in the markets that are more mature, right? I think I believe long-term trend more in the stock market, for example, than like than in Bitcoin, where I might
Yeah.
believe short-term trend more because
So
it's just
maybe,
less.
yeah, I feel like a common question too, and more the advisory space from an investor perspective, and just thinking about tax consequences as it relates to turnover. Managed futures can be a high turnover strategy. Like, how do you think about some of that short-term trend? I mean, obviously, it's a very liquid market, so the implications of turnover,
Yeah,
but ultimately, where I'm going with this question as I'm thinking through it is talking about kind of that signal to trade timing and the ability to capture. So any thoughts maybe first on just like the higher turnover nature? I mean, it's a byproduct of what you're trying to capture. So I think it's
yeah,
embedded and it's understood, but any thoughts on turnover?
yeah. So with respect to the high turnover, with respect to tax structuring, that's when we leave to our structuring partners, like Simplify.
Yeah.
That one's with you.
Yep.
Our job is to provide you with an absolute return stream that we believe in and that we think can scale for our
And
collective clients.
yeah, maybe a
So
quick comment on that as well. I think the benefit again of having these higher turnover strategies in ETF vehicles. Again, just the innovation of product and the ability to bring to market something that typically has been reserved for, hedge fund type structures with lockups, but the ability to bring a higher turnover strategy and have it be semi-tax efficient for our investors is a key reason for kind of the vehicle wrapper du jour, I would say, in this market. So
yeah,
maybe the better question then for you would be around kind of the signal to trade and kind of thinking
yeah,
about.
totally. So leaving the tax questions and ETFs versus hedge funds and all that structural stuff to a side for a second.
Mhm.
Having a higher turnover strategy can be highly desirable in the sense that you can be more adaptive to changing conditions. The problem with passive investing, generally speaking, is that new information happens and you do not react. Right? Now, reacting all the time is not a great idea either, because you'll churn your book and you'll bleed out on transaction costs and you might make the wrong decision and get whipsawed and all those terrible things. We can all agree that at the far end of the spectrum of how reactive am I to information, infinitely reactive is not a great idea. Okay? But I would suggest that never reactive is also a terrible idea. And that goes completely against the dogma of the market, and that's a hill I will die on. I'm just a moderate person. I'm just like, well, you know what? Sometimes we want to react to information, sometimes we don't. Like, that's the position I want to take. Your average dollar cost averaging passive investor is like, there's no information you can give me because the market's so smart. There's no information you could ever give me that would change my behavior. And like, that is totally, in my opinion, dead wrong. Okay? And by the way, the world is changing fundamentally faster now than before, which means on the margin, whatever you thought was the right amount of reactivity to new information previously, it's probably higher now if transaction costs are unchanged.
Interesting.
And that's, again, a hill I'm very happy to die on. And so the benefit of a higher turnover strategy is, number one, you can react and manage your risk more appropriately. Right? And then number two, you can access certain types of risk premium that you just can't access with a passive structure. In particular, risk factors like the commodity convenience yield, or trend/momentum, or episodic dislocation, right? Or loosely put, commodity convenience yield, trend, and arbitrage relative value. And those are also long-term factors that have returns that are different than the equity risk premium and the bond duration carry premium, which are passively accessible.
Yep.
And that's super important because those other statistically, kind of consistent, or not consistent's the wrong word, statistically present risk premia in the data are other sources of return that are not particularly correlated to the level of the stock market. And that is super awesome. And so when we talk about, there's no free lunch in finance other than diversification. We truly believe that at Altus Partners, and I hope you believe it at Simplify too. I'm pretty sure
Yeah, you said no free lunch earlier. I was going to call you out, the Harry Markowitz.
Yeah.
So I'm
Yeah,
glad
you're
you
totally
looked back
right.
there.
Yeah, and my view is like, yeah, I want to be levered to the profitable growth of the economy. That's the equity risk premium. I want to be levered to duration and the duration premium that exists, right, for providing your savings for the productive use in the economy and liquidity transformation, right? That's basically fixed income. But I want to have other exposures too that also generate returns, because I want my capital working as efficiently as possible, creating value in the economy. And that means helping the market get to where it should be so that relative pricing is efficient. And that basically comes down to trend and reversion.
Yeah,
Right?
I think one thing
And
you
working capital for the system, which is basically the commodity convenience yield. And all those things are totally accessible in futures. And that is awesome because it's a way to efficiently put your capital to work in the economy.
Yeah, I think one thing you mentioned that resonates with me is just thinking about how quickly the world and markets are moving today. In order to continue to capture opportunities, alpha, diversification, whatever risk premium you're searching for, you have to have models, trading algorithms, the ability to capture that. And so I think one thing that's really resonated just in our conversations over the last few months is really your view on like, how do you capture that and implement that in the effort to avoid kind of that alpha decay, as it's referred to. And so the ability of these types of strategies naturally are faster moving, right, than maybe a buy and hold type equity or fixed income strategy.
Yeah.
But then even within the managed future space is how can we fine tune and optimize these models and signals to just increase that timing quicker.
Totally. So the first answer to that, I think, is a really simple answer to a simple question, which is how do we operationally deal with having multiple sources of predictive edge and implementing them effectively? And the short answer is with software, because there's a lot of stuff going on in a lot of different markets, and they have interesting covariance properties, and you want to build portfolios that capitalize on them in the right amount. So that's the short answer is you need technology to do it some way. And that's okay because the markets are heavily technologized now. So that's great. But you kind of need a pro of some kind building performance software in order to be able to extract some of this edge. It needs
Yeah.
some level of professional management, I would say.
Yeah, and I would say too, that's likely what's driven kind of the reference to like black box
Yeah.
versus, when you sit down with your fundamental or discretionary equity manager and they talk about they went and they visited the factory, they met with management, they looked at the balance sheet or the income statement, you know, trusting or believing in your manager, given all of this algorithmic trading and kind of the systems that have been constructed, it is a bigger hurdle, I would say, for a lot of
It,
investors from a due diligence perspective.
it
Um,
is. Yeah, it is. And we get that, right? There's a comprehensibility issue with this stuff, which is just sort of like it sounds complicated and it's hard to believe. So well, I guess I'll believe it if I see it. And that's fine, right? That's why we're committed to transparency. It's like, sure, look at the positions. Every day that goes by, you see how the systems do. Maybe you can get a little bit more of a feel for kind of what's going on.
yeah,
But then the second slightly more complicated answer to your question is um, when you're putting on dynamic bets in the market, you want to bet bigger when you have more edge and smaller when you have less edge. We all agree that volatility is the enemy of compounded returns because if I draw down 50%, I have to draw up 100% to get back to flat. Right. So volatility drag is a problem. We want to minimize volatility drag. And by minimizing volatility drag, the way to do that is to not take risk. Right. So generally speaking, if there's no edge, we certainly don't want to be warehousing risk because it creates volatility drag for no reason. Right. On the other hand, when you do have edge, the more edge you have, the more sense it makes to be bigger. So what you're trying to do is maximize your slugging percentage while minimizing your volatility drag. And that means being diversified because that's the free lunch, but not over diversified. You still want to be able to concentrate in the best opportunities because they are the source of your return. And so a big part of the art and science of all this is sizing judiciously around your edge, allowing yourself to be concentrated when it is worth it, statistically speaking, and then also to get to back to your point on trading velocity, stopping out quickly when you're wrong,
yeah,
because it's a statistical game and you're going to be wrong a fair amount of the time.
yeah.
So that I think is kind of the main thing. It's like really understanding how the sizing of individual trades in relation to each other relates to the perception of statistical edge and the cost of trading this stuff because market liquidity is not free.
So maybe in the interest of time, I think a comment you just made about sizing and, when you have edge, increasing position sizes, and it's typical, as is in a lot of investment strategies, you have a couple home runs that really drive strong outperformance. So maybe if we tie this back to the last calendar year, 2024, and kind of think about, and this won't, we don't need to go into the weeds here on full year attribution, but really just thinking about like what were some of those home runs? And I asked that question with the backdrop of from an index perspective, if you just look at the market broadly for 2024, you're probably not too energized about managed futures. It was a pretty flat year. So let's talk a little bit about the space broadly. And again, this is not specific to any manager,
Yeah.
but trend following in general in 2024, why was it a little bit lackluster? And then maybe, highlighting what were a
Yeah.
couple of those home run
Yeah. So
opportunities.
yeah. So I think the lackluster bit is pretty straightforward, which is the trend alpha did not perform very well in fixed income and did not perform very well in energy or metals. Basically, in energy, you had a directionless oil market with really large volatility and a lot of whipsaws, and that hurt. Put a big drag on performance because momentum just didn't work in oil in particular. In rates, you had a big rally on the back of a perception of a slowdown at the beginning of the year and in fixed income products from a price perspective. And then I'm sorry, I got that backwards. Sorry, we had the Fed pivot in December of 23,
Mm-hmm.
October to December. Interest rates came down. bond prices went up, and then they basically reversed in the first couple of months of the year.
Yep.
And then there was a perception that the economy is slowing down too quickly. But it was, again, a really big whipsaw, and now more recently, again, growth is strong and full employment and all that.
A lot of bond market volatility in 2024.
Yeah, and also we saw episodically through the middle of the year a decrease in correlation on bonds versus equities. Like equities continued to perform strongly, and bonds sold off. And that was because the market got more focused on re-rating growth expectations higher. And that growth narrative kind of dominated the liquidity narrative for time. But bonds basically haven't worked very well at all from a trend following perspective, because like we're kind of at the top, and nobody, from a recent Fed hiking cycle, which was monumentally historic in nature in 22, and nobody can decide, what the right place is. And then in metals, it was pretty wild. You've had this trend in gold, but it kind of is reversed at the top. And then much worse, I think, for the industry, you had this incredible enthusiasm in base metals at the beginning of the year, and then an implosion in Chinese growth expectations right around end of April, early May, which caused a huge reversal, and basically the market going from copper is the greatest trade on planet Earth from an electrification and energy transition perspective to, oh my gosh, they're never going to buy another air conditioner in China kind of thing. And copper basically at the local lows. And that was pretty tough if you were a trend follower only trading trend.
Yeah.
Now, in terms of the opportunity in the market, to me, the biggest and least talked about opportunity in commodity markets, maybe for the next 10 years, and certainly this year, is climate change. And I don't mean to be political about it. It's just a fundamental fact of what's actually happening in the market. If you look at the softs market, cocoa, coffee, and orange juice are on fire, because they grow in hot countries, and the weather patterns, maybe it's not climate change, but whatever it is, the weather has made supply side disruption in those crops a really big issue. And it's created supply and demand imbalance, and they've gotten more volatile, and they've gone up a lot. And the higher volatility has taken some of the liquidity out of the market, but it's exacerbated basically the impact of changes in demand in the context of a less elastic supply curve. And that created a monumental trend following opportunity in softs.
Yeah, I think that's fascinating, that point around just weather patterns and its impact of course, on commodities, because typically when you think of a strategy that holds commodities, you think of oil and energy, and from a political standpoint, you're thinking about like, oh, the anti-ESG trade, like let's trade oil and energy. And then really what we're seeing here is these opportunities are presenting themselves because of weather-related patterns, whether it's, climate change or something else, is driving this opportunity set. So I think that's a really fascinating point.
Let me just tell you, the energy imbalance of planet Earth does not care at all about anybody's political narrative on climate change or otherwise. Okay, the bottom line is there's more watts per square meter being retained in the energy balance of the planet now than there has been in the past. And that means that the process of the weather system and the ocean system moving energy from the equator to the poles to radiate out into space is happening at higher velocity with a larger dispersion in localized events. And interestingly, short grains, in the same way that long softs was driven by the weather, short grains was also driven by the weather, and was another amazing opportunity in 2024, because it was warmer in America where grain grows, and it rained more. And when it rains more and it's warmer, guess what? The crop yields are awesome.
Yeah.
Right. And so, like, to me, when I think about investing in the asset class of commodity trend over the next 20 years, ask yourself this: is the next 20 years going to involve a equal, lower, or greater, frequency of major weather-related disruption to supply chains? Okay. I have an opinion, and it's not a political opinion. It's a physical reality opinion that has to do with a greater energy throughput on planet Earth. And that's happening. Yeah. And in 2024, that was a totally tradable opportunity, and my investment products made money on it. Yeah. Maybe I'm not allowed to say the last bit,
no,
but
that's
what happened. But that's what happened, right?
I do.
And you know what? Like, I think there's going to be more of that in the future, a lot more. And I think it's totally investable. And, I hope the human race deals with it. But I can tell you this: we're not yet ready, because the price of chocolate's up a lot. Yeah, it's going to keep going up if this keeps happening. Or It'll rain a lot, it'll be just right, and it'll crash too fast. But the bottom line is the volatility in this stuff is too fast for us to deal with the current infrastructure. And so probably the price related disruptions will be high.
Yeah, and one reason too, I appreciate you sharing through that lens, because it's not the obvious lens when we talk about managed futures and trend following. I think it makes it a little bit more real, a little bit more tangible to understand what's driving some of the returns across various tradables or underliers in the strategy. But I also think too, and we've seen this firsthand, investors looking at more of the dynamic play on commodities rather than a static play. So I think a
For
lot of
sure.
us think about the reason you would hold commodities in a portfolio is that, that natural inflation hedge. So whether or not you think we're past peak inflation or
Yeah.
inflation resurges, moot point, the ability to take advantage of this ever-changing commodity market through a dynamic approach like trend following, where you can go long and short, I think is really, really fascinating and
Yeah.
again helps build out a case for this in a broader portfolio.
I totally 100% agree with you. The bottom line is there's more risk premium than just the equity risk premium and the duration carry premium in bonds. Okay. And those are great historic risk premium, and they've been particularly great in the last 20 years because the government did a lot of financial asset inflation. Okay. That's not likely to pertain in the next 10 years. Okay. But all the other long-term risk premium that exists, like working capital for the supply chain, trend momentum breakout, and reversion slash arbitrage, right? Those risk premia are likely, in my opinion, to perform particularly well in the next 10 years. And the cost of capital is higher now. So, and this asset class has not grown that much. So there's a dearth of capital and an increasing demand for capital provision in the space. And by the way, it's liquid, right? Because it's about trading liquid stuff.
Yeah.
So to me, if you're an allocator looking to buy alts, you'd be crazy to buy more private equity and private credit when you can buy liquid diversifiers right
Yeah.
now. So,
From an operational administrative perspective, like the benefits of an ETF vehicle. And if you think about
oh yeah,
again, like back to the basics on managed futures as that portfolio diversifier, if this is in your portfolio and we do see equities sell off by 20%, you have dry powder the next day to redeploy from managed futures
sure.
into equities to take advantage. So it's a really tactical tool in your portfolio. And so
Yeah.
maybe as we wrap up, just talking about like from a portfolio allocation perspective, because anytime you're allocating to alternative assets beyond stocks, bonds, the question number one is, do I pull it from stocks or bonds or both? There's no right answer, is the short answer. But typically what we would see, again, going back to the basics of what the purpose of this is, equity beta, equity risk is the number one driver of risk or volatility in a portfolio. So as you're diversifying away from that, we typically think about sourcing this from bonds, tends to provide stronger outcomes for our clients. But again, there's no
Right.
right or wrong answer here.
But equities might be wrong as a buy and hold for the next 2 years. We just don't know yet, right?
Correct.
So I'm not sure what you should sell to buy this, and I get that it's challenging because the right answer might be I have to sell a little of multiple things, and that's a harder decision
Yep.
than it's a one for one, like for like replacement. The same
Yep.
thing, just better, right? Because the whole point of this asset class is it's different, which means you need to think about a risk allocation to this in the context of reducing correlated risk in another way. And so to me, I would view it through the lens of what's the risk contribution of this thing given its lower correlation, and do some kind of re-risk budgeting at the portfolio level into this, which probably means selling more equities than bonds, but probably a little bit of both.
Yeah.
The goal with these things is to provide a capital efficient return stream that is equity like in terms of its capital efficiency and absolute return characteristics, but it's truly uncorrelated. So that's kind of my view on the sizing question. Yeah, and then with respect to the ETF wrapper for this type of risk premia, again, active risk premia are awesome. I'll die on that hill, right? The ETF wrapper also is awesome. Let's be honest, it's a 100x better user experience.
Mm-hmm.
I think most of than a lot of private vehicles. It
Yes.
just is. It's transparent. It's understandable, right? And that is a great experience. Now, the challenge with an ETF wrapper is that there are certain things that you can do in a private vehicle that you simply can't do in an ETF, right? But my view is because the user experience from an onboarding, allocation, dynamically resizing, transparency perspective is so much better. Anything that can go into an ETF wrapper is going to go into an ETF wrapper in the market. And so we want to be in front of that, right? Our products work as hedge funds and SMAs, of course, but our view is let's provide value in an ETF wrapper because provides a better experience for our clients. And from my perspective, that means my business can scale.
Yep.
Right. And then I'll limit to, private, of course, we'll provide the private structures to clients that want that for structural reasons. But fundamentally, the stuff that I will be putting into private product is stuff I just can't do in an ETF.
Yeah.
Like higher frequency stuff or that or discretionary
Yeah,
stuff.
there's a bit of a delineation between that. And I think
For sure.
for most of the marketplace, at the advisor level and from an allocation perspective, like having this operationally resource light intensive vehicle just allows advisors to spend more time doing what they're paid to do, which
Yeah,
is providing advice. And
totally.
hopefully not managing the intricacies of a private vehicle, which can be very resource intensive. So we're probably preaching to the choir here on that. So let's wrap up. Really appreciate all of your insights, Charlie. Great to hang out. But I think the main takeaway for me is really the opening comments around it being a bull market and diversifiers, the liquidity of these, not only the vehicle, but the underlying markets, the futures markets, highly liquid opportunities to produce alpha and equity-like returns with low and even no correlation to equity. The use case is pretty strong there. So any closing comments before we break?
Nope, it's a bull market and diversifiers. That's my view. And the right amount of reacting to information is not zero. And so active product in markets where active trading is efficient and feasible makes a lot of sense. And really happy to be working with Simplify on all the above.
Perfect. Well, thank you for your time. As always, Simplify is here to answer any questions you guys have. So thanks for tuning in.